Bismillahirrahmanirrahim. Dear students, today we will going to discuss the basic accounting equation. Uh, the first transaction is Mr. Riaz commences his business with cash rupees 50,000. So the first thing, we have to open a capital account, which is actually the investment of the owner, which is rupees 50,000, and we have to attach the plus sign because the investment in the business has increased. This side is also called sources of finance because we have two types of sources of finance. One is in broader sense called liabilities, and which is fund you obtain from others like banks, individuals, corporations, and the capital means the investment of the owner in case of sole proprietor business. In case of partners, it is called partners capital, and in form of company, it is called share capitals. On the left side, we have assets. So we have invested rupees 50,000 in form of cash. So we have to open a cash account, and if we have to attach a plus sign with 50,000. In the second transaction, we purchased furniture on cash rupees 10,000. So we have to open another account, which is furniture, and in this transaction the furniture account has increased by rupees 10,000. That's why we attach a positive sign with the furniture, and we have paid for the purchase of furniture in form of cash. So we have to deduct 10,000 from the cash account. Now we have a balance of 40,000 in cash and furniture plus 10,000, which is equals to 50,000, and both sides are equals, means asset equals to liability plus capital, which is the basic accounting equation. Now in a third transaction, we purchased equipment for cash rupees 10,000. Now we have to open another account, which is equipment, and in equipment account we have to add rupees 10,000, and we have to attach positive sign because equipment account has increased. Now there is no change in the liability and the capital account because we purchased equipment from cash account. So we have to deduct the cash from the cash account, which is minus 10,000. Now we have a cash balance rupees 30,000, furniture 10,000, and the equipment 10,000. In the fourth transaction, we purchased equipment on account. Now in this case we add rupees 5,000 in the equipment account, but we also have to open another account, which is called account payable, means we have to pay in future, and the liability has increased by rupees 5,000. So we have to attach a positive sign with the liability account because previously we have no liability, means we have zero liability. Now we have rupees 5,000 liability in the account of accounts payable. It means we finance the equipment from the liability account. Now the fifth transaction is sold equipment for cash. Means we already have some equipment. Now we have sold equipment for cash rupees 2000, whose cost were rupees 1500. Sorry, we have to correct here, is which is equipment, not a merchandise. So when we sold out equipment whose worth is 1500, we have to deduct the amount of 1500 from the equipment account, and because we sold equipment for cash, we have received 2000 in terms of cash. And what's the difference between 2000 and the 1500, which is actually our profit, 500. And whenever profit increases, it ultimately increases your capital, so we have to add profit in our capital account. Now sixth transaction is sold equipment on credit for rupees 4000 costing 3000. Now in this transaction we have to deduct the 3000 from the equipment, because we have sold out the equipment whose worth is 3000, and we have to add rupees 4000 and account receivable account. We have opened another account whose name is account receivable, means we yet to have received a cash. That's why we called it account receivable. So we add 4000 in account receivable account, and we deduct the 3000 from the equipment account. Now the difference between 4000 and the 3000 is 1000, which is also our profit. Means we sold the equipment whose cost is 3000 by receiving 4000 rupees, means more than its cost. Now the seventh transaction is paid rupees 1000 to creditors for equipment purchase. Means we have paid to the creditor from whom we purchased equipment previously on credit. So we have to deduct 1000 from the cash account, and it would ultimately decrease our liability, which is 1000 have to deduct from the accounts payable. It means we haven't paid fully our liabilities. We have paid some of the amounts from the previous liabilities. Now the last transaction is received cash from our debtor. Debtor means the person who you have sold something. So that's why we have 1000 increase our cash account, and we have to deduct 1000 from the account receivable account, because we have received 1000 from our debtor, so we have to deduct or less the 1000 from that account. So these are actually the basic accounting equation. We have some introductory transactions. If there is any problem, you can directly ask me from my website by typing in contact form financeasim.wordpress.com. Thank you very much.